navigating market corrections with a long-term game plan for your financial goals and dreams. Welcome back to Sugar Mama's Fireplay. I am financial planner Canna Campbell, and today we're diving into a topic that's been on the minds of many investors lately. That is market corrections and the importance of sticking to a long-term game plan. With rising fears of recession, falling share markets, and commodity prices, it's easy to feel unsettled right now. However, as an investor just like you, it is crucial that you stay calm, rational, and focus on the bigger picture, which is, of course, building long-term growing passive income streams for that financial independence and to be able to retire early. In fact, let's be honest, market corrections actually present opportunities, sometimes once-in-a-lifetime opportunities. So together, let's explore what is happening in the economy right now and how you and I can together navigate these uncertain times with confidence, information, and of course, always backed by facts, figures, and recent insights. Welcome back to Sugar Mama's Fireplay. I am financial planner Canna Campbell, and today we're diving into a topic that has been on the minds of many investors lately. That is market corrections and the importance of sticking to a long-term game plan. With rising fears of recession, falling share markets, and commodity prices, it is very easy to feel unsettled right now. However, as an investor, just like you, it is absolutely crucial that we stay calm, rational, and focused on the bigger picture. That is, building our long-term growing passive income streams, which will in turn give us that financial independence and an early retirement. And let's be honest, market corrections quite often present opportunities, sometimes once-in-a-lifetime opportunities. So we need to have our eyes wide open here. So right now, we're going to explore what is happening in the economy right now and how you and I can both navigate these uncertain times with confidence, of course, always supported by facts and figures from recent economic insights. Now, as always, all of my content is general in nature and educationally based. It is never personal advice, which is why you should always speak to a financial planner and ask them for personal advice when it comes to your investing, wealth creation, and strategic needs. But in the meantime, let's focus on what is happening in our economy right now so we are informed and educated. All right, so number one, it is so important that we understand the current economic climate. Recently, share markets have been hit really hard, particularly in the US, where we've seen a significant drop of around about 8.5% from record highs. Global shares are also down by about 8.9%, and as you probably know, the Australian market has taken a 5.7% fall. Bond yields, commodity prices, and even the Australian dollar have dipped, reflecting concerns over economic growth. And this is felt worldwide. Now, why is this happening? Well, recession fears are back, and they are pretty loud right now. And these are not just speculative opinions. Several key indicators are flashing red, particularly in the US, where the inverted yield curve, which is a classic recession warning, has been signaling trouble since about 2022. But historically, this particular indicator, that is, the inverted yield curve, has predicted every US recession over the last 60 years. So while the US economy has shown resilience until now, the risk of recession remains realistically high. And this uncertainty is naturally driving market volatility with so many investor emotions running high. But hopefully after listening to this episode, your emotions will be calm and rational. All right, so how does the US market and what is going on around the world with these fears affect Australia? So closer to home, Australia has not been immune to what is going on right now. Household debt servicing costs are at record highs. Real household spending has slowed. Yep, we're all tightening our belts, and unemployment is starting to creep up. with it now sitting around about 4.1% from a low of 3.5%. While the risk of a recession here is estimated to be about 50%, Australia could follow the US into a downturn, which could affect both our economy and the global demand for our exports. Central banks, including our own RBA, are in a very tricky position. You see, interest rates have been raised aggressively over the last 2 years to help control inflation. But now there's a risk that they've actually gone too far. And if inflation falls below target, we could in fact see some rate cuts, which may help the economy, but this is going to be a long-term process. And I really don't think the RBA are going to have any knee-jerk reaction to what is going on in the US. In fact, my biggest worry is that the RBA may in fact be too slow to react and make those interest rate cuts a little bit too late. But that's just my personal opinion. As you know, in the meantime, so many households are really suffering with so much financial stress and anxiety. So what do we need to do? And what do we need to understand about what is happening right now? Well, there are two things that you need to know and understand to help make sure that you are making smart, intelligent decisions with your money and not necessarily part of the herd mentality. So number one is you've got to understand the importance of sticking to a long-term game plan. So with all this uncertainty, it is completely normal and natural to be feeling anxious right now. But it is important. You've got to remember that long-term investing is about weathering these storms. Shane Oliver, who's one of my favorite economists to follow, points out that market corrections like the ones we're experiencing right now are stressful, but they are also a very natural part of the investment cycle. So please don't think this is abnormal. It is healthy. It is just part and parcel. It is just part of the game that is investing. And you see, for long-term investors, hopefully like yourself, and of course, definitely me, I'm a long-term investor, these dips are actually opportunities, blessings in disguise. You see, historically, markets have always bounced back from corrections and even recessions, rewarding those investors who stayed the course, even if it meant just sitting on their hands and doing nothing. It is incredibly difficult to try and time the market, but sticking to a well-thought-out strategy, ideally backed and created by a financial planner, can most definitely help pay off in the long run. So please don't forget. And of course, let's not forget that superannuation accounts are also designed with this long-term view in mind. Think about it. Have you ever really worried dramatically about your superannuation when there has been a market correction or pullback? You probably haven't even gone and looked at your superannuation. So this is a long-term investment plan like super. So why are you treating them differently? Think about them in the same category. And in times of market volatility, it is essential that you focus on your broader investment goals, whether it be building up passive income like myself or just focusing on capital growth. The most successful investors are the ones who stay patient and don't react impulsively to these short-term swings. As the quote by Warren Buffett goes, the stock market is the device of transferring money from the impatient to the impatient. I want you to be the patient people with me. And don't be afraid. The second important thing that you need to understand about the market right now, so that this actually in turn benefits your financial situation and, of course, your wealth accumulation goals, and that is the opportunity that lies in these market corrections. That is the blessing in disguise. Recessions and market corrections often present buying opportunities. So many times when you look at a chart of the market and what it's done over the last 20, 30, 40 years, and you look at the wars, the terrorist attacks, the healthcare crises, they've actually presented incredible opportunities. That is, opportunities to buy the same quality assets at a significant discount and make some wealth, even dare I say, over the medium term. So, for example, when share prices fall, so do the valuations. That are valuations on a surface level. It doesn't mean the value of the company has necessarily fallen. So what this then means is you can sometimes buy these high-quality companies at a significant discount. Think about the companies with strong fundamentals and a history of weathering economic downturns. For example, supermarkets. During an economic crisis or recession, do we still go to the supermarket? Do we still buy bread? Do we still buy milk? Yes, we do. Do we still put petrol in our cars? Do we still use electricity? Yes. These were the companies that I'm talking about, strong fundamentals that are almost immune to these economic downturns. Of course, they're not going to be perfect at all times, but this is why it's so important that you have a diversified investment portfolio. And as I said, these are the ones that tend to bounce back stronger once the storm has passed. Another thing to consider is, of course, your dividend strategy. With Australian shares offering relatively high yields in comparison to, say, international investments and shares, investors still continue to earn income off their share portfolios, even if the capital value of their share portfolios has dramatically fluctuated and is down in the short term. So whilst your, say, supermarket stock is down, say, 5% or even 10%, you're still getting the same amount approximately in dividends each year. So what's the difference really? And it is so important to remember that downturns can help cool off inflation, which we all know is a problem right now, which then means lower costs of living and potential interest rate cuts can now come back on the table to be considered, which then, of course, help ease the financial pressure on so many households and businesses right now, eventually then in turn boosting the economic activity that we all need. So you can see now the importance of thinking about your long-term goals, which is building up your passive income, whether it be $50,000 a year, $80,000 a year, $100,000 or $200,000 a year. Focus on what your goals are. Turn down the volume. Forget about the white noise around you. And if you are feeling resilient, brave, and educated enough, look at the blessings in disguise. Are you going to look back at this time right now and think, gosh, I wish I invested more then, or I wish I had stayed and just sat on my hands and let my portfolio do its thing? You want to look at this as an opportunity. Is there spare money potentially that you can add to your portfolio or even to your superannuation right now if that's appropriate? So whilst the economic environment might seem really frightening right now, the best course of action for most investors like us is to stay focused on the long-term horizon. Market volatility, whilst incredibly unsettling, it's an inherent part of the investing journey. By staying calm and sticking to a well-structured game plan, you will be well positioned to take advantage of all these opportunities that arise around us. And remember, successful investing isn't about avoiding or trying to avoid downturns altogether. That's in fact impossible. It's about how you respond to them. Keep your eye on the future, trust your strategy, invest time exploring what additional things you can do for your strategy to make the most of loopholes and opportunities. And do not let short-term market noise derail your long-term financial goals. So today's episode is just a short but sweet one. Thank you so much for tuning in. If you found this episode helpful, please don't forget to subscribe to Sugar Mama's Fireplay and make sure you share your thoughts with me on social media. And in the meantime, I'll see you next Monday morning where we will continue on exploring how you can take control of your financial future, one smart investment at a time. And never forget, investing is a marathon, not a sprint. If you need to take a break, slow down, walk a little bit, jog a little slower, take a sip of water, stretch your muscles, that is perfectly fine. Just keep going. It's all about sustainability, endurance, and perseverance. Trust me, it is always worth it. In the meantime, stay informed, stay calm, and most importantly, stay the course as you keep that financial fire burning bright.